Today we're tackling a critical topic: taxes. Taxes can erode your returns, so we'll break down how each strategy impacts your after-tax wealth with real-world examples. Let's dive in. Now, let's unpack the tax implications of dividend stocks. Dividends are typically paid quarterly, and they're taxed in the year they're received. In the US, qualified dividends, those from companies like Procter & Gamble, held for at least 60 days, enjoy preferential tax rates: 0%, 15%, or 20% depending on your income. For a high earner in the 37% bracket, a $10,000 dividend from PG, yielding 2.4% in 2025, might face a 15% tax, costing $1,500. Non-qualified dividends, like those from REITs such as Realty Income, are taxed as ordinary income up to 37%. That same $10,000 could lose $3,700. The catch? Dividends force taxable events, even if reinvested. If you're in a high tax bracket, holding dividend stocks like Johnson & Johnson with a 2.8% yield in a taxable account can erode returns. The solution? Tax-advantaged accounts like IRA or 401k, where dividends compound tax-free until withdrawal. Data from the IRS shows 70% of dividend income flows to high earners, making tax planning critical. Now, growth investing, think NVIDIA or Tesla. Growth stocks rarely pay dividends, so you're not taxed until you sell. This deferral is powerful. Capital gains are taxed at 0%, 15%, or 20% for long-term holdings over 1 year. Imagine you bought NVIDIA at $100 in 2018, now worth $1,200 in 2025. Selling $10,000 triggers a $1,500 tax at 15%, but only when you choose to sell. Short-term gains for holdings under a year are taxed as ordinary income, up to 37%. Day trading Shopify in 2022 could have cost you dearly. Growth's tax advantage lies in control. You decide when to realize gains, aligning sales with low-income years or tax loss harvesting. But beware, growth stocks are volatile. NVIDIA's 2022 dip of 50% could have forced a sale at a loss, nullifying tax benefits. Plus, high valuations, TSLA's PE ratio once hit 100, amplify risk if markets sour. Which strategy wins on taxes? It depends. Dividend stocks like Coca-Cola suit tax-advantaged accounts or low-income investors qualifying for 0% rates. Growth stocks like Alphabet shine in taxable accounts, letting you defer taxes. Historical data shows tax-efficient growth portfolios can outperform dividend-heavy ones after taxes, but only if you manage sales strategically. Smart investors blend both for balance. They hold Microsoft, with its 0.8% dividend and growth in an IRA, and Amazon in a brokerage account. They also use tax loss harvesting to offset gains and always consult a tax advisor. Taxes aren't destiny. Plan smart. That's the tax showdown for dividends versus growth. Know your bracket, leverage accounts, and invest with purpose. Next video, high-yield dividends and potential risks. Until next time, keep building wealth.